In security analysis, we are actually identifying the securities that we are going to include in our portfolio. So, while considering a security for an investment purpose, we look into mainly two aspects. One is the risk of the security, and the second one is the return it offers. So, the return depends on the cash flows to be received from the investment. So, when we are investing in certain securities, we are actually expecting a return from that investment in the form of dividends and also a capital appreciation, that is we should be able to sell that share at a higher price. So, here they have given the formula for calculating the expected return from the security. So, they have given R equal to forecasted dividend plus forecasted end of the period stock price divided by initial investment minus 1. So, in this example, they have given a share whose price is 120 and he expects a dividend of rupees 5 and he hopes to sell it at rupees 175. So, by calculating, they get the return as 50%. So, but we know that there is a probability or there is a chance that this exact 50 will not get. This can be either 60 or can be 70 or it can be either 40, 30 or even 20. That is the risk factor in it. So, there comes the difference between risk and uncertainty. In uncertainty, we cannot calculate or we cannot quantify anything. But for risk, we can actually assign probabilities and we can calculate how much risk we have to actually undertake for a given security. And this risk is actually calculated by assigning or making a probability distribution of the future returns. So, here they have given a sample of a probability distribution, this portion. So, they have given the return as 50, 40, 30 or even 60, 70 and they have given the probability of occurrence of those returns. So, this distribution is actually formed by looking at the past and adjusting with the current situation. So, to sum up, that is to understand the risk and return of a security, we have to measure it. So, these two measures are called as summary statistics, that is the expected risk of a security and the expected return of a security. These two are the things that has to be calculated before taking an investment. So, first we will be seeing how to calculate the expected return of a security. The expected return of the investment is the probability weighted average of all the possible returns. If the possible returns are denoted by xi and the related probabilities are p of xi, then the expected return may be represented as x bar and can be calculated through this formula, that is x bar equal to sigma I equal to 1 to n xi into p of xi, that is probability of xi. So, they have given a formula, that is they have given an example how it is calculated. So, here they have given the possible returns, that is xi, and here there is a probability, that is p of xi. So, they multiply both of them and then we get this xi into p of xi and then they sum it up. So, sigma I equal to 1 to n p of xi equals to 48. So, we have calculated the return of our security as 48%. Next, we are going to see how to calculate the risk. So, risk is usually denoted, that is first of all the return is denoted by x bar or mean return, and this risk is denoted by, that is variance or standard deviation. The most popular measure of risk is the variance or standard deviation of the probability distribution of possible returns. And variance, as we know, is denoted by sigma square. And the formula for calculating is shown as sigma square equal to sigma equal to 1 to n xi minus x bar the whole square into probability of xi. So, from this table we are knowing first column is possible return xi, the second column is p of xi, then the deviation xi minus x bar. So, from where we are getting this figure? X bar we had actually calculated the return as 48%. So, 48 minus 30, 30 minus 48 minus 18, 40 minus 48 minus 8, 50 minus 42, etc. And then we are squaring the deviations, then xi minus x bar the whole square into the probability, that is 324 into 0.10, so 32.4, and then we are adding up and we are getting the variance as 160%. So the standard deviation, the root is 10.77%. So what does this 10.77% actually indicate? The statistical definition of standard deviation is the deviation from the mean. So this variance 10.77% indicates that our return can be either 48 plus 10.77, that is 58.77, or 48 minus 10, that is 38%. That is the indication of the standard deviation. So, the variance and standard deviation measure the extent of variability of possible returns from the expected return. So, in this method actually we are calculating the mean return and the deviation from the return or the variance from the return. So, this measure is actually called as mean variance approach. So, we had talked actually about standard deviation. So, suppose in an example, security A and B, the first security A's return is 50, standard deviation is 30, and the security B's return is 40 and standard deviation is 10. So, what does this indicate is that the expected return from security A is 50. Standard deviation is 30%, means the returns can be either 50 plus 30, 80, it can go up till 80, and it can decrease 50 minus 30 till 20. So, the return will vary from 20 to 80. And in security B, the standard deviation is 10 and the return is 40. So, the range will be 40 plus 10, 50, 40 minus 10, 40 minus 10, 30. So, 30 to 50. So, which security will a person choose? Actually, this will depend on the risk preference of the investor. There are three categories, that is, one is risk averse investors, that is, they do not like taking risk, they fear risk. So, they will most probably prefer low risk securities or government securities. Then there are persons who can tolerate a medium level of risk, and then there are risk takers, that is, they are ready to take heavy risk to incur heavy return. So, here 50 plus 30, 80, there is a chance of getting 80 return, but in security B there is a chance of getting only maximum 50. But in the risk aspect, the risk is that 50 minus 30, it can fall till 20, but here in security B it can fall only till 30. So, based on the calculation, based on the risk and the return preferences, either one of the securities will be chosen. So, that's all we are going to see in this video. That is, we saw how to calculate the expected return of a security, and we saw how to calculate the risk of a security. So, when we say risk, we know that risk comprises of systematic risk and unsystematic risk, that is total risk. So, here we had actually calculated the total risk. So systematic risk is the general risk, is the market related risk, and unsystematic risk is the company specific risk. So company specific risk actually can be avoided or can be zero. How? Means just simply avoid that company's share. So your risk and systematic risk will be zero. But systematic risk we cannot control. So systematic risk is the risk which is the relevant risk, and in the next video we will be learning on systematic risk.